Welcome to Quartz Smart Investing. I'm Merrill Brown. Our guest today is Ryan Detrick, Chief Market Strategist at Carson Group. Ryan, thank you for joining us.
Merrill, thank you for having me. Appreciate it.
Pleasure. You're a rather lonely voice who thinks September, generally the market's worst month, might reverse historical trends and go well for the markets. What's your scenario?
That's right. You know, as we've all heard, September is the worst month since 1950, worst month the last 10 years, 20 years. Oh, by the way, the worst in a pre-election year. So we know that. But when we took a look, when you're down a lot going into September, like by 10% or more, like we were last year, going back 50 years, what happens in September? The wheels fall off, down anywhere between 8 and 11%. Those 5 times you're down 10% heading into it. So a bad start are those worst Septembers. The good news, when you're up at least 10%, like we are this year going into September, and you were down in the seasonally weak August like we just were, 8 of the last 10 times September was higher, some really good gains. The final comment on this, though, the rest of the year was higher 10 out of 10 times under that scenario when you're up 10% going into September, but also we're down in August. So those are some things to think about when all we hear about is how bad this month tends to be.
Earlier this summer, people were sitting in this chair and elsewhere predicting big gains in the S&P, maybe up to 5,000 by the end of the year. Where do you think the S&P is going to end the year?
No, we would agree. I mean, we think all-time highs is likely. Now, you were talking about this summer. We came out at the start of this year overweight equities. We were saying stocks could gain between 12 and 15% for the year. Now, that was, actually one of the more bullish calls for the year. Now we think between 21 to 25%. So that put us right around that area we're talking about. But it is likely to us, when you see the economy still, it's moving forward. The consumer is still surprising to the upside. Inflation's coming down. There are still really a lot of positives. And we hear, hey, stocks are expensive. We get it. But if you take out technology and communication, stocks actually are relatively cheap. So all these factors we've been overweight all year. We're still overweight and think new all-time highs is likely before this year's over.
Can the Tech Big Seven, or whatever the acronym of the moment is, continue to prop the market up as well?
We think they're going to be more market neutral. They don't have to go up necessarily to pull the market higher. We really think some of the opportunity, honestly, the rest of this year are your cyclicals. Energy makes up, about 4% of the S&P 500, so that could go up a lot. Might not matter to the market, but there are some places when you look at cyclicals and small caps, we like those areas as, again, we can avoid a recession. I think that's going to be the big gains the rest of this year.
Next, Ryan Detrick on why consumers have helped prevent a 2023 recession.